Welcome. This is an introduction to Telema's Quantitative Technical Analysis (QTA) research. Quantitative technical analysis is the fusion of machine learning-based quantitative techniques and traditional technical analysis. It strictly focuses on modeling the price and volume of an asset. Let's explain why we think QTA should be part of your investment toolkit. QTA is widely used by investment professionals because it has proved itself to be an important market timing and risk management tool. Whilst fundamental analysis helps set a fair value for an asset going into the future, QTA can help provide a quantifiable entry point alongside constructing a comprehensive risk framework for managing the investment. It also aids them in modeling structural breaks and shocks which could have an adverse impact on the price, such as a shift in the mathematical trend. This allows them to effectively optimize their exposure to a given investment. A typical piece of research starts with a historical price chart of the instrument in question. The instrument's name and the forecast horizon are along the top. It usually displays a significant portion of the recent trading history and is annotated with any key patterns and price levels that are relevant. The blue bars on the right represent our machine learning model's forecasts. Below the chart sits a table containing the most notable support and resistance levels. The left-hand side of the table contains the three most prominent resistance levels in ascending order. Resistance levels are areas which have previously led to a decrease in price and are generally viewed as opportunities to sell an asset or take profits. The stars denote the relative strength of each level, and the comment section details its origin, commonly a significant pattern or event. The right-hand side of the table displays the three most important support levels in descending order this time. Support levels are areas which have previously led to increases in price and are considered to offer good value should the market move down to that price again. Because the training of the machine learning model has been so heavily influenced by technical analysis, it can be helpful to overlay some market commentary to partly explain the model's projection. Below the tables is a paragraph or two of text. In truth, detailing why a hugely parameterized model outputs any given sequence is at best difficult and at worst extremely boring, unless you really enjoy linear algebra, of course. However, we do our best to explain why technical analysis principles might find such a forecast likely. We also dive into market participant psychology and positioning to help explain the highlighted patterns and to illustrate how they could shape future sentiment. Let's have a look at some examples of QTA providing accurate time series forecasts in the real world. Here is a chart of the S&P 500 with a quarterly forecast horizon calling for the rally to continue to 2275 based off of support from the upwards channel. It accurately models the continuation of the trend. Here is another example, this time of the Australian dollar versus the US dollar, calling for a sharp downside reversal to occur based on the break of a prominent trend line. This is a great example of the power of being able to forecast structural breaks. And finally, we have the emerging market government bond index yield, with our expectation for the market to retrace lower in a set flag formation. This demonstrates QTA's ability to fully capture the complex behavior of asset price movements.